Mahesh Patil, good morning. It's easy to turn bearish in this market, but should one really turn bearish? If yes, why? If no, why not?
Yeah, good morning, Nikunj. So, I think clearly, I think the Trump tariffs, what have come out, are slightly worse than expectations. But clearly, if you look at from a India standpoint, I would not be too bearish. I think, see, I think while the tariffs have been imposed, okay, across the various countries, relatively, if you look at India, tariffs are much lower than some of these other partners, right, on the global front level, whether it's China, Vietnam, Bangladesh. So in that sense, I would say that competitively, I think will not be worse off over there. Okay, that's the first thing I would say. Secondly, is that I think I would guess that there could be bilateral talks, okay, which could be engaged, I think, in the next few weeks. And I think India has done well, I think, in terms of trying to work with the US. So you could see some kind of give and take over here, and the impact could be probably mitigated over there. So that's the first part. Secondly, is that from our perspective, I think India, I think we started, I think, our uh, kind of a weakness or a downturn in the markets, and the economy started much earlier. So our pain started from the first half of this last fiscal year, right? And we have gone through that pain now. And in fact, now I think on the domestic side, I would say that we are seeing now recovery. Good thing is that on the monetary side, we have seen a significant amount of easing. Liquidity, which was negative, almost 2 lakh to 3 lakh crores, is now actually, even the month of March, which is a tight, we have actually turned slightly positive. So I think that, so the on the monetary side, I think it's likely to be supportive of growth. And I think we are seeing in a kind of a earnings season, okay, where I think the worst probably would be behind in this quarter. And next year, again, the base would be slightly favorable. So I think all in all, I would say that from an India standpoint, the impact is there, but for a few sectors, clearly, even like, for example, a large exports like IT and pharma, clearly, because of this slowdown in the US, you might see exporters getting impacted. But again, mind you, I think the overall impact compared to with the US trade, if you look at impact on GDP, our assessment is it will not be more than, say, around 20 basis point or so. So I think we should be fine. I think that's how the market is also reacting. We haven't seen such kind of a large reaction to it, and I think it should probably settle down. I don't see a major downgrade to our earnings, okay, for next year, except for one or two sectors. So I think we should be okay. I mean, any dip because of this correction, I think could be a good buying opportunity, I would say. Also, from a selling perspective, if you look at FIS selling, I think there's been a huge selling which has happened in the last 1 year or so, right? And now the data point suggests that FIs are now underweight India by almost 250 basis points. This is the highest underweight was what we've seen since the Asian crisis. So I don't see there is much selling which is like to be there. And if at all, US dollar weakens, and we've seen recently money coming into emerging markets on the back of what's happening in China, I think the pressure of FIS selling which was there, I think that clearly can ease off, and that could really limit a downside over here.
Interesting, Mahesh. So that's what the one is, wondering as an Indian investor, what do you do? Do you wait for things to settle down? Because I don't think being in a hurry is going to get you anywhere. Wait for how much of a damage the US equity markets see, what the collateral damage for India is going to be, or would you be in a hurry to buy the decline should it come aligning with the US?
So I think there is still uncertainty over there. We still don't know whether US goes into recession or not, because if that is the case, then there will be a global risk off, and you will see much larger impact over here. That's not the base case at this point in time. So I would say that it's not one would advise to rush in to buy, but again, the next couple of quarters, also 1 or 2 quarters, you could see the markets kind of going up and down depending on the news flow globally. And this is a good time to slowly start to accumulate, not be aggressive. In fact, we have been advocating that this is a good time to actually put money into some of the asset allocation funds, because other asset classes, whether it is fixed income, has also given a good return. We have seen a good rally in the bond yields. Gold has been a spectacular performer and can continue to be a good asset class to diversify into. So it's better to diversify across the asset classes. So multi-asset funds, the asset allocation funds are the funds which, if an investor looking to invest to the mutual fund route, will be the better funds. and obviously sticking to the larger caps still at this point in time, because mid cap and small caps, while they have corrected and are looking slightly attractive, I think it is not time to dial and go full risk on at this point in time. So it will be a kind of a slow gradual recovery, which is what we would expect. Even in the domestic final recovery in the GDP also would be slow and gradual. We don't expect any sharp recovery. Earnings growth trajectory also will be slowly over the next few quarters. We can see that going up. So I think it's nothing to rush, I think, but clearly I think it's a market to buy into the dips. With the 3 to 5 year outlooks, I think we should still be doing reasonably well.
Right. Good morning, Mr. Patil. This is Cheryl also joining in the conversation. I just wanted to get your views, especially at this point in time. Do you think that one sector pick, if you talk about equity markets, you did say about diversifying your portfolio, looking at other asset classes, but if you have to talk about equities, would it be domestic-oriented counters or sectors that you will watch out for at this point in time, given the fact what is happening in the global markets and global turmoil that we are facing right now?
So, yeah, I mean, it looks like I think one would have to focus on domestic-oriented sector, but even for the export-oriented sector, like sectors for textile, for example, right? There again, I think you would probably, India would be much better on a competitive basis vis-a-vis some of the other countries. So I think that's a sector, even its export-oriented sector, could possibly benefit in this overall scenario. But you are right. I think we are looking at sectors which have kind of underperformed or underwhelmed in the last 1 or 2 years, and are from a cyclical perspective are looking good. For example, in that context, one of the banking and financial services sector, which we've already seen some traction in that in the last 2-3 months, is starting to outperform now. And I think now with the easing of liquidity, what we have seen, I think the deposit growth, which was a bit of a concern, I think that should slightly improve, and that should we should see some improvement in the credit growth over there. Valuations are also for the large cap banking names are good. The rate cut cycle is pretty much that we expect another 50 basis point of rate cut, so that should help the NBFCs also. And the concern on the credit cost also, I think they are kind of pretty much priced in. Another interesting sector would be the consumer sector, right? Because that's again a big underperformer. We have seen very weak growth last year, and I think that could be again a contrarian sector to look at, because as we step into the next fiscal year, I think the base will be supportive. We have seen some stimulus given to consumption, okay, in the budget. We also have the pay commission coming in next year, in the next fiscal year. So I think consumer-oriented companies, even the small ticket discretionary consumption, the retail sector can be a sector, okay, which could look good over here. Also, if the commodity prices come down a bit, I think if the global slowdown is what we're looking at, I think that should also help into the margin improvement, which has been a bit of a challenge last year. So I think consumer discretionary, consumer staples, banking and financial services, on the export-oriented side, the textile sector, and also utilities. I think power sector, again, while there has been a slowdown in the government capex, but the power T&D space looks fairly good in terms of the investment. So these are some of the pockets, okay, where we see them doing well in the coming year.
So good having you on the show. Thanks as always for your time.
If you like this video, then like, share and subscribe to ET Now.